Tech today came out with a strong set of fourth quarter numbers. Let me take you through them. The key highlights: revenue growth in constant currency terms came in at 3.8%. Dollar revenues grew 4.1% and rupee revenues grew about a little over 2%. And with all this was largely in line with expectations. Net profit growth also came in at over 12%, and that was a surprise thanks to lower tax expenses. CNBC TV 18's Kritika Saxena dives into those numbers to find out just how HCL Tech has blazed a trail when most Indian IT companies, remember, are struggling for traction. Take a look.
Unclear, uncertain, trying to stay relevant. These words littered the commentary HCL Tech turned in a year ago along with its quarterly numbers. This time, however, the commentary is far more upbeat and accompanies a set of strong numbers that demonstrate just how other IT companies are struggling to grow. Given this backdrop, HCL Tech has forecasted revenue growth of 10.5 to 12.5% in constant currency terms in FY18 and 9.9 to 11.9% revenue growth in dollar terms. These numbers have failed to completely satisfy the street, but the company insists these forecasts are realistic.
FY18, as you said, 10.5 to 12.5 is the overall growth. And every time when we did an acquisition, we've said what the potential revenue impact from an annualized basis is.
So if there were to be more acquisitions in the next 1 year, could I say that you'll be able to cross that 12.5% mark?
It's too early, right? I mean, acquisition, target, acquiring, integrating, converting to revenues, I think there is a pretty long cycle.
What did make the street really happy was the guidance on margins. The company expects margins of 19.5 to 20.5%. That's 50 to 100 basis points higher than expectations. But the company says the usual pressure points like currency volatility, pricing pressure and the after effects of the acquisitions made through FY17 should not pose a problem.
This year we have, for our internal budgeting purpose, we have taken $6 rupee at 65.5 rupees.
Okay.
And on that done the number crunching. Okay. And we still believe we will be able to maintain, even at that rate, 19.5 to 20.5.
Growth will continue to be driven by a revival in key markets of US and Europe. While HCL Tech's American business grew 5% over the last quarter of FY17, Europe actually saw a 3% contraction, but the company insists this is just a sequential blip. Its digital services business has been a trailblazer as well, reporting revenues of $1.1 billion and accounting for over 13% of total revenues. And HCL Tech expects this run to continue over the coming quarters.
We are completely open to cannibalize our application services revenue so that we can build our digital business. So in at least 70% of the wins that we've had, we've been able to replace a large traditional provider for a digital program.
HCL Tech also does not expect to face the same problems other IT companies are facing with stricter visa regulations in the USA and changing manpower requirements to cope with a greater push towards automation and digitization. For one, it says it has always preferred hiring local talent, and this practice will not change.
We have 12,000 people in the US, of which close to 55% are locals.
Yeah.
So our fundamental talent strategy has been well balanced between local talent and leveraging some of the higher end talent through the some of the skills which we have in India. So I don't see anything significantly changing. We will continue to hire locals, we will continue to hire freshers, entry-level talent.
Cognizant has announced cutting down of workforce. Infosys has also indicated to that. Has there been a rationalization of employees? Have the lower performers been removed? If yes, could you throw some number into it?
So there is no such plan to do any rationalization of manpower.
Okay.
However, we over the years have been following a appraisal system where there could be there could be a churn on account of non-performers. But other than that, there is nothing, no special program.
All this has HCL Tech believing it will outperform its peers through FY18, just as it has done through FY17, with a robust deal pipeline and the ability to adapt to a changing external environment, helping it cut through any global and domestic headwinds. In New Delhi, Kritika Saxena.
Meanwhile,